in the correct spot when you're ready to invest in stocks, but you don't know how to take the initial steps towards investing in stocks. Before you plunge in, there's a lot you should know. Here's a step-by-step approach that will help you ensure that you have the proper method to invest in the stock market in 2021. Hello viewers, and welcome back to our channel. If you are new here, before watching this video, you have to like and comment below to watch great video clips to enhance your knowledge. Number 1. Identify your strategy for investment. First of all, how to start investing in stocks. Some investors decide to purchase equities, while others adopt a less active approach. The many techniques for investing in the stock market. Individual stocks. If and only if you have the time and desire to investigate and assess stocks continuously, you can invest in individual equities. If so, we advise you to do it 100%. A clever and patient investor may ultimately outperform the market. However, there is absolutely nothing wrong with choosing a more passive strategy if things like quarterly profit reports and mild mathematical computations do not seem attractive. Index funds. You can opt to invest in index funds, which track a stock index such as the S&P 500. Aside from buying individual equities, we usually favor the latter in active comparison to passively managed funds, although there are certainly exceptions. Index funds typically have lower fees and are almost sure to mirror their underlying indexes' long-term performance. The S&P 500 generated a total annualized return of around 10% over time, which enabled significant wealth to be developed over time. Robo-consultants. Finally, the robo-consultant has become another popular choice over the last few years. A robot consultant is an agent who primarily invests your cash on your behalf in an index fund portfolio that fits your age, risk tolerance, and investment objectives. Not only can a robot consultant choose your investment, but many will also improve your tax efficiency and automatically make modifications over time. Number 2. How much stock is to be invested in? Let's discuss first the money that you shouldn't put into stocks. At least for 5 years, the stock market is no place for money that you might need. While the stock market is nearly sure to increase over the long term, short-term stock prices have too much unpredictability. Indeed, a 20% decline in 1 year is not rare. The market plummeted by more than 40% during the COVID-19 epidemic in 2020, then rebounded all in a few months. Allocation of assets. Let's now talk about your investment money. That is, the money you probably won't need in the next 5 years. This is an asset allocation idea, and here several considerations come into play. Your age, your specific risk tolerance, and your investing goals are also important factors. Let's get your age started. The goal, in general, is to progressively make equities less appealing when you get older to maintain your money. If you are young, you will have decades to go up and down in the market. But that is not the case if you retire and rely on your investment revenues. Here is a fast rule that might support you in determining the asset allocation of the stadium. Subtract your age from 110 years. That is around the percentage of your money that you should be invested in stocks. This includes mutual funds and ETFs that are stock-based. The rest should be for investments with a stable income, such as bonds or high-income CDs. This proportion can then be adjusted up or down depending on your specific risk tolerance. Number 3. Open an investment account. All the advice on investing is startup stocks doesn't work if you can't purchase supplies. To accomplish this, you need a specific account type called a courier. Companies like TD Ameritrade, E-Trade, Charles Schwab, and many more offer these accounts. And creating a brokerage account usually takes just minutes and is a rapid and easy procedure. You may fund your brokerage account by emailing a check or sending money via EFT transfer. Opening a brokerage account is usually straightforward, but before picking a particular broker, you should think about several things. Account type. First, establish what kind of brokerage you need. Most people are just beginning to understand how to invest in the markets, which means deciding between a basic account and a single pension account, IRA. You may buy stocks, mutual funds, and EFTs in both kinds of accounts. Here are the primary reasons why you buy stocks and how easily you wish to assess your money. You probably want to have a regular brokerage account if you want fast access to your money, invest only for a rainy day, or wish to go beyond the yearly IRA maximum. However, an IRA is a fantastic way to go when your objective is to establish a retirement nest egg. These accounts are available through two significant variations: standard IRAs and Roth IRAs. And specialty IRAs are available for self-employed and small business owners, including the SEP IRA and Simple IRA. IRAs are tax-friendly venues to purchase stocks, but it is tough until you become older to withdraw money. Compare costs and features. Most online stockbrokers have removed trading fees, so the vast majority, but not all, have equal costs. There are, however, some other significant distinctions. Some brokers, for example, provide consumers with a wide range of teaching tools, investing research access, and other services particularly beneficial to novice investors. Others offer foreign exchange trading capacity, and some have existing networks of branches that are great for guiding your investment. The convenience and functionality of the trading platform of the dealer are also available. I've used many of them and can tell you in my own right that some are more clunkier than others. Many of them will allow you to sample a demo version before you commit money, and I strongly suggest it if that is the case. Number 4. Select your stock. Now that you're looking for fantastic beginner-friendly investing ideas, we address the issue of what stocks you should purchase. 5 outstanding stocks are here to assist you in getting started. Change your portfolio. You understand I invest exclusively in firms. Avoid stocks with significant volatility until the investment hang is reached. Avoid penny inventories. Learn the fundamental measurements and ideas for stock evaluation. Number 5. Investment continues. This is one of Oracle's most important investment secrets, thanks to Warren Buffett, the Oracle of Omaha himself. To get excellent outcomes, you don't have to do extraordinary things. Note, Warren Buffett is not only one of the most pleasing long-term investors in your investing plan, but also one of the best knowledge sources. The safest approach to making money in the stock market is by purchasing shares of major companies at affordable prices and holding them as long as they stay big, or until you need the money. You will suffer volatility as you do this, but you will generate significant returns on investment over time. Thank you for your feedback, and please remember to subscribe to my next videos.